Hey everyone, welcome back to Signal or Noise, episode 12. Charlie Bilello here, and with me as always, Peter Mallouk. Peter, I'm going to jump right in and talk about a topic. I think it's probably the most important topic for investors, because if you can't stick with your investment, then it really doesn't matter how it does. And so there's this concept about this behavior gap. So investors, they have fear, they have greed, we all have this, and it leads to underperformance versus the vehicles they're invested in. So Morningstar does this study every single year. They just came out with the latest data there, and they showed that investor returns of around 6% trailed the returns of the funds they're invested in by 1.7% per year every single year. Is there a more important issue for investors than trying to narrow this behavior gap? And I really, when it comes to an advisor, I think this is kind of the number one job, trying to help protect investors from themselves.
Yeah, I think a lot of people, these behavior gap studies like Morningstar puts out, I think a lot of people don't really understand how does the investor underperform the fund that they're in. And the reason is actually really simple. So most funds don't attract capital until they've done well for a long period of time. Uh, and then what happens is all the capital goes in, and then over time, most funds underperform. And so that outperformance oftentimes is attributable to luck or risks that have worked out that may not work out in the future. So the people that invest in them are there for the part where things go bad. So like two very famous examples. One, Bill Miller was the only mutual fund manager in history, I think, to beat the S&P 500 15 years in a row. That fund attracted a massive amount of capital. The biggest inflows were during those last few years he outperformed. And what happened after that? The fund completely collapsed. And who was there? Well, more people were invested when it collapsed than in the beginning, where no one had heard of the fund. And if you'd invested in the fund from the beginning to the end, it was an underperforming fund because of how poorly it did at the end. A more recent example is the ARK funds. Cathie Wood's fund did really, really well investing in big tech. No one was in it really when it started. It was only when it outperformed so dramatically that it attracted a bunch of capital. And of course, at its peak inflows, the fund started to underperform. We see this happen again and again and again with investing. Chasing performance in the publicly traded markets is a big mistake.
And what do you think in terms of narrowing this gap? What a piece of advice would you give investors, or how can investors change their behavior or their portfolios to kind of mitigate this risk? So we're all looking at that performance data. The best thing, of course, is not to chase it, but are there other ways you think that could help narrow this gap?
Well, I mean, the best things to know, well, I've got my financial plan. What asset classes am I supposed to own? Okay, if I'm supposed to be 80% stocks, how much of that should be in the US? Now, how much of that should be large US? How do I buy that a very low cost way, a very tax efficient way? And I want to own it for a decade or more, right? So that way, as I'm going through cycles, I can stick through the cycle. I'm not using an active manager that's probably going to underperform the index. I'm not chasing the historical returns. And it gets you out of that in and out mentality where you're always looking at who did best over the previous 5 years, because unfortunately, that's not an indicator at all on who's going to do better going forward. So focus on the asset class you need, buy at the lowest cost, most tax efficient way that you can, and hold for the long run.
Right. And what I would add is in terms of two things, in terms of complexity and volatility. So you mentioned the ARK Innovation ETF. And if we look at that sector equity category or non-traditional equity, it could be in one of those categories. The more complex it is, the more volatile it is, really the harder it is to stick with when it's not doing well. So know yourself, know what you own, know why you own it, and really have a portfolio that's as diversified as possible, because that's going to mitigate that risk. And if we look at the allocation category here, you can see, probably no surprise, it has the smallest gap. So those target date funds where you have a mix of a little bit of everything, people tend to stick with those more often than not, because they're not as swinging as wildly as these hot funds, so to speak. So I think that's an important factor as well. And we saw Morningstar actually noted this, that within almost every category, the most volatile funds had a bigger behavior gap. So if people are seeing those extremes, well, they're doing in both directions. The extreme to the upside, so ARK's 2020 performance, where they're up over 100%. Well, that was the volatility that people like. Unfortunately, they rushed in after that fact. And then volatility, of course, on the downside, people hate as well. And because markets are mean reverting, because fund returns are mean reverting, you have this notion of a gap. So I guess it comes down to knowing what you own, knowing why you own it, and really trying as best as possible, not using short-term performance as a reason to invest in a fund.
Yeah, exactly. We both agree, like chasing the performance is killer. And what these target date funds have in common with what I outlined is you're basically choosing your allocation and you're sticking with it, right? And so you don't feel the volatility of the portfolio the same way.
Yeah, and just knowing what you own, coming back to this alternative, and we talked about this on a previous episode. When you're in something that you don't understand, and many people don't understand the alternative or hedge fund type funds that are in their portfolio, when that fund then goes down, you're more likely to abandon it because you never understood it in the first place. All right, so let's move on. Where inflation is made. You tweeted this out. I love this video. Milton Friedman, famous economist, Nobel Prize winner, had this video. I'm going to play this here for everyone. Hopefully, fingers crossed that it works. Let's listen to it.
Inflation is made in Washington because only Washington can create money. And any other attribution to other groups of inflation is wrong. Consumers don't produce it. Producers don't produce it. The trade unions don't produce it. Foreign sheiks don't produce it. Oil imports don't produce it. What produces it is too much government spending and too much government creation of money and nothing else.
So I love that. Too much government spending and too much creation of money. And you would think that would be somewhat obvious today, and you think that would be what people are talking about. But if you listen to the FOMC has a press conference every single month, and I listened to the last one, I listened to it, I try to listen to it after the fact and with an unbiased view and just listen to what they're talking about in terms of inflation and what's causing and what's driving it. And the fascinating thing to me, Peter, is if you listen to the last 2 years, you listen to all of these press conferences, it's almost never mentioned the two big elephants in the room, one being national debt, that's up 54% over the last 5 years, and two being the US money supply, up 47%. And then you have all of these people that are shocked to learn that the US inflation rate is at the highest rate since the early 1980s, when guess what? We were doing some similar things. So
Right.
do you find this fascinating?
I'm blown away by it. I mean, I think that to me they're very subtle lies, right? I mean, so they say, oh, well, the supply chain is causing inflation. Well, it's true. It's just not the primary thing causing inflation, or higher oil prices cause inflation. It's also true, but it's not the primary. It's not the primary reason. And I think 90% of this is how much money is in the system. That's what's the biggest driver of what's happening here. So it's not absolutist, like Milton Friedman said in the video, and even he admitted later in his life, like, okay, maybe I was a little over the top saying this is 100% of it.
Yeah.
But it's too much to ignore. You just can't ignore it and point it at all these other issues as being the only reason there's inflation.
Yeah, I mean, too much money chasing too few goods. It makes sense intuitively. The data empirically backs it up. And why is it important to acknowledge that? Well, if you don't acknowledge where it's actually coming from, then you're probably not going to change course in terms of policy direction. Now, what I will say is the good news, and I've been talking about this for the better part of the last year, is I think the Fed got the message in terms of the money supply. Even though they're not saying it,
Yeah.
the money supply growth peaked in 2022. We're seeing actually lower level of money supply over the last year, which is encouraging. And I think that's probably one of the primary reasons why the inflation rate has come down. But in terms of national debt, we're not yet learning that lesson. And if we look at the national debt here, I put a table together of these milestones. And as you can see, these $1 trillion milestones happening with much more frequency of late. And we crossed above $33 trillion for the first time. That's $10 trillion higher than where we were at the end of 2019. And Peter, this is a chart I know got your attention, got my attention as well. We spent a few signal and noise talking about that debt ceiling and how, in my view, it was a farce. You can't have a ceiling if you're spending way more than you're taking in tax revenue. And we lifted that ceiling back in early June. And wouldn't you know, 4 months later, we have $2 trillion more in debt. So what is it? I mean, this is just, it's kind of shocking, but kind of not, because this is the way things are going. But it's obviously not sustainable at this pace.
It's not sustainable. It's literally treated like it's play money now. And if they keep it up, it will turn into play money. I think that the issue with Congress and the president, no matter what party, is there's no skin in the game, right? There's no consequence. So if they go over the budget, they're still, Warren Buffett had a solution to this. Hey, just have a law that says if we don't have a balanced budget, you can't be up for reelection. The problem would be solved. Right here, if you have a balanced budget, you're less likely to be reelected, because it means you haven't fought really hard for your constituents to get a bunch of money for whatever project they want. And so the way they negotiate is the Republicans get what they want for their people in exchange for the Democrats getting what they want for their people. The president goes spends on what they want for whatever, and there is no balancing effect, right? And so we just keep adding to this deficit. And this is the sort of thing that won't be an issue until it is. In other words, we're not going to feel the real consequences of this until we really feel them all at once. And I think that there's eventually going to have to be some sort of bipartisan effort to put something in place that is somewhat reasonable, because this really is not conceptual. This is a debt that has to be paid, and it's one generation spending money that a future generation is going to have to pay. We see this over and over again in every economy in the world, eventually. I mean, the key is eventually. So whatever president or Congress is spending now, or the last one or the one before it, they're not going to feel that consequence. It's going to be decades down the road. I think that's why we just, in the way our system is set up in the United States right now, no one has any incentives to fix it. It's unfortunate.
It's the opposite of what you teach investors and savers in terms of you need to have delayed gratification. Putting off that spending that you can't afford today for the future is going to lead to benefits. In the future, the government does the opposite. They say, why put it off? Borrow today, and we'll worry about the future when it comes. And this is really, it's important, I think, to understand, because a lot of people say, well, the numbers are bigger today, and so, of course, trillion is not what it used to be. And yes, that part is true. But the bigger issue is not just the amount of debt, it's that debt is outpacing growth, and it's done so by such a huge margin over the last 15 years. If we look at U.S. national debt, you're looking at 8.5% per year increase on that debt, while nominal GDP is growing at 4% a year. So it's not like we're just doing it a little bit more. We're doing it a lot more. And if we look at that debt in terms of the percentage of GDP, which is really how you should look at it, we've increased substantially over the last 15 years, from pretty much doubling around 60% of GDP to 120. And then a natural question, of course, is, well, it hasn't hurt yet. When will it hurt? And I think in terms of a breaking point, nobody knows, but you know enough that you don't want to get so close to that where it becomes a real problem. And I don't think it's a coincidence, Peter, if we talk about what's going on in interest rates today. I don't think it's a coincidence that they're going up the way they are, because simply you have all of this supply of debt and you don't have the Fed buying them anymore. We talked about the money supply. And so that interest rate goes up. And when these securities come due, and we have 30% coming due this year in terms of treasuries, and over the next, basically by the end of 2025, half of these will come due, and they're coming due at much higher interest rates than we've seen in over 15 years. So that therein lies the problem, because now you have a higher interest rate on that debt. It becomes harder to pay that back, and you have a choice then to be made. Am I going to borrow more to just pay off that higher interest, which is only going to accelerate it, or do I finally find some fiscal discipline? And it's to me, this should be the number one issue that people are talking to going into 2024. I'm not sure that it will be, but I can't think of anything more important for my kids and their kids and the future of this country than getting this under control.
Yeah, I think it's just too hard for people to understand and think about, because people talk about how bad the debt is for decades and nothing appears to happen, right? The average American voter doesn't feel anything about it. And so they think about, well, I'm concerned about what's happening in my backyard. and this is just an issue I can deal with later. Well, the U.S. government's about to have a huge percentage of its debt. It's kind of like a homeowner whose mortgage is about to go variable, and it was at 2.5%, and it's going to come back at a much higher rate. And I think we're going to see the national debt really explode in the next 5 years between the higher interest rates, the completely uncontrolled spending, and all of the wars happening. I think it's going to be really interesting to see how they finally try to address this. Because I think it's going to get to a point where no one can ignore it anymore.
Yeah, it might come to it might have to come down to that really third rail of politics where you're not supposed to talk about Social Security or Medicare, but it's going to come to the point where we're paying so much interest on our debt that we're saying we can't afford these other programs, and you don't want it to come to that point where you're talking about cutting back on these programs that are pretty popular before people do it. But it seems like we're headed in that direction. So we'll revisit this again at 34 trillion, which at the pace we're at today won't be too long from today. But let's move on to something, probably the number one question advisors are getting and people keep asking me. Charlie, why should I take risk in the stock market or the bond market, which is, in the midst of its longest bear market in history, if I could just buy treasury bills and chill? So Jeff Gunlock, he always has these great sayings, and he said it's time to buy a T-bill and chill at some conference he was at. And I think what he meant by that is simply 5.6% in short-term treasury yields. Why should I take risk in anything else? And if we look at the 3-month treasury bill yield, highest since 2001. So it's a whole generation of investors that haven't had this opportunity. But what I would say, if you go back to January 2001, and we were just about to enter a recession. If you thought something similar back then and said, I'm just going to lock in this 5.6% yield, initially it would have felt pretty good because you had stocks go down in 2001, 2002. But if you look out over a 20-year period, what you would have lost by just sitting in cash over that period of time is enormous. So we have S&P 500, 318%. We look at the 10-year Treasury bond, 163%, and cash at 31%, which I think there's a lot of lessons in there. But number one is that yield perhaps is not permanent. We can't predict the future, but you're not guaranteed that 5.6%, let's say, for the next 20 years, right?
Yeah, I think that's the big thing is it's a short-term rate. It's going to change, and you can go buy bonds today. While bonds are in a 3-year bear market, that's because existing bonds have declined in value. New bonds are coming out with higher yields. You can get tax-free bonds. There's a lot. The bond market has gotten a lot more favorable, actually, for investors. I think if you look at the stock market relative to interest rates, everyone thinks when interest rates go up, the stock market does poorly. That's not necessarily the case. Many examples of the stock market doing well in a rising rate environment. And again, we're looking at that treasury. That's the short-term treasury that's at 5.6. You can go in there and find that market turn against you very, very quickly once things are under control. So it's just not that easy, unfortunately, for people. And if you go there after tax, you get 3.9% or something around that. You could be missing some really big opportunities.
Right. But what I would say, Peter, if we look at portfolio allocations, we look at people with shorter time horizons or people with lower risk tolerance, this is good news. It hasn't been embraced as such because, as you said, there's been short-term pain in the bond market. But it was only a few years ago in 2021 where you really had to reach for yield if you wanted to get that higher return. So 7.5% is kind of the pension fund benchmark in terms of their target rate. And back in 2021, I wrote a piece saying that you would have had to invest over 60% in equities, and there's no obviously guarantee to equity returns, and 36% in corporate bonds, and you couldn't have anything in treasuries or treasury bills because the yield was so low. And today, that percentage of equities, and again, no guarantee there, has dropped below 30%. So for people who need yields, people in retirement, people with a low risk tolerance, this is very good news, I think, and that's being lost here just on thinking about treasury bills because, like you said, the best predictor of bond returns is that starting yield, and now we have a 10-year treasury bond of close to 5%, right?
Yeah. Yep, I agree.
So let's move on to the abnormal last decade. And it's been unusual, Peter, because normally we see leaders lead, of course, for some period of time, and then that leadership gets replaced by someone else. So there's this interesting study here looking at the top 100 US companies at the end of one decade. And they did this going back to 1960. And they showed each and every decade where those top 100 companies that started the decade, where that weight was at the end of the decade. And if you could see here, every single decade before the recent one, you saw a pretty significant decline, which simply means that the leaders were being replaced by other companies. And if we fast forward to 2010 and look at the decade following that, that just didn't happen. The big companies stayed big. And what has that meant for in terms of markets? Well, we're seeing the smaller companies underperform. If we look at the Russell 2000 relative to the S&P 500, worst relative performance here since 2001. And I know we've touched on this before, but do you think there's been some type of paradigm shift here where these big companies, they have bigger moats? We talked about Apple and the dominance there, and Amazon and Google, and we know that the government is thinking about trying to break them up, and they have certain lawsuits pending here. Do you think that something has changed, or do you think simply this is just we're living in the outlier, and investors shouldn't expect the next 10 years to be the same as the last time?
I think that what we normally see is what your graph shows, right? Is that whatever is in the top 5 or 10, they look so formidable. GE, ExxonMobil. You can't imagine a world where they're not at the top. IBM, and then all of a sudden something happens. That's how capitalism works. Blockbusters puts everybody out of business, and then Netflix puts them out of business. Now there's a bunch of other streaming services that might challenge Netflix and its dominance. And we see that over and over again. But to your point, there's been an anomaly over the last 10 to 15 years where we see companies like Apple, just the dominance persists. And I think that there's a couple things for that. I think one, the rules of capitalism have not changed. They will eventually give way to 10 other companies. Somebody's going to be doing a podcast 20 years from now, and they're going to look back and go, remember how dominant Microsoft and Google and Apple and Amazon were. And here's what's changed. But what big tech has done is it's allowed people to become more dominant quicker. So the path to dominance is faster. Like if you think about how Blockbuster had to take over, it was one store at a time, physical store, location. It took forever. Well, Netflix, once it catches on, it's overnight. Amazon, when it catches on, it's overnight. It moves very quickly. You can see a new app come out and have 1 billion followers in a month.
ChatGPT, right?
Yeah. ChatGPT is what a perfect example. I mean, just the fastest to a whatever number of users it was the fastest in history, right? It was
100 million, yeah.
Yeah, 100.
Fastest
It was insane. So the dominance comes very, very quickly. And then to your point, there's a moat. It's hard to penetrate the Apple ecosystem or the ease of Amazon or so on. So all it means is it's more dominant quicker. You could take this, pull ourselves out of the industry and look at, like, say, musicians. It used to be like you toured, you developed a following, you released an album, you built this audience over a long period of time. Now somebody can show up and have 100 million followers and be one of the 5 biggest in the world very, very quickly. It's just so much easier because of technology to gain attention fast and to stay dominant. But it will eventually give way. And so I don't think the rules have changed. I think we're still going to see these rotations, but it might be the regulators. It's harder for the regulators to break them up, or it's harder for a competitor to penetrate their way in. But capitalism is capitalism. It's eventually going to work out. Just like the most dominant sports team, eventually it gives way.
So, from a portfolio management perspective, the way I think about this also is even if, let's say, they remain there, in order for you, so the argument is, why shouldn't I concentrate, right, in those big names? That's what really someone's asking when they're talking about this. And the argument against concentration would be to say, even if they remain in the top, they have to lengthen that lead, right, for you to benefit from that concentration. So yes, that gap has widened over the last decade, and that's what's been particularly helpful to U.S. tech growth stocks, right? And investors are paying a premium now because of that. And now the question is, well, is that going to continue to widen? Are those higher valuations going to continue? Because if that doesn't happen, they could still be, the top 4 companies could remain the same, but the weighting comes slightly down, so they could stay in the top, but you're still benefiting from that diversification. And I think it's just so hard. And coming back to short-term performance, it's so hard when you're living in that period of time and you have that narrative around, especially a year like this. We're seeing pretty much a record dispersion between the top 50 companies in the S&P 500, up 23%. And then you have equal weight down, small caps down. Just that narrative is very hard to combat as an
Well,
investor,
I
isn't
mean,
it?
the two biggest questions I get from clients around their portfolio are, why am I not just in these, 5 or 10 really big companies? They've dominated not for 1 year, 5 year, 10 year, but even longer than that. And then number two question I get is, should I be getting out of the S&P 500 index as the anchor of my portfolio because so much concentration is in the top 5 or 10 companies? I mean, the top 5 or 10 companies is a huge percentage now of the S&P 500, very disproportionate, more than it's ever been. And so, it depends how you perceive this. Oh, wait a second, I've got too many eggs in one basket, or why are my eggs not all in this basket? I think this is really a case for indexing. If you own the index, these are your biggest positions. You've participated more in this growth than you have in any of your other positions. And it has become a bigger part of your portfolio, but it's not overwhelming the portfolio by any means. Each position is still a few percent of the overall portfolio, and a very reasonable contained risk. You can participate in the upside without having a blow up along the way.
Right. And if we're talking about 10 years, yes, it's been abnormal, but I guess the bet is for the next 20, are these companies still going to be in there? And it's hard to argue that they will. I mean, if we look at 1990, I just look at the leaders there: Exxon Mobil, General Electric, IBM, AT&T. Go down the list there. Not a single company from 1990 is still there today. And from 2000, that's only a little over 20 years, just Microsoft is there. So if you
Yep.
lengthen the time period, not to say that some of these companies won't be there, but I think the odds suggest that there are going to be new leadership. And even if these companies are still there, they won't have the gains that they had in the last 10 years. And you diversify because it's really risk management on a principle first and foremost, because if this leadership, if the future looks different than the past, you have to in advance prepare for that. You can't do it after the fact. And the best time to diversify historically is when it's the most painful to do so.
Right.
So when has it been really painful to invest in small caps or international? It's now, it's today. And diversifying when it's not painful, when those things are helping you, like they did from 2000 to 2010, now then it's too late, right, so to speak. So you
Right.
need that diversification when it's painful. You need it when it's in advance. And this is to your point here: top 10 companies in the S&P 500, 30% of the index. Like, is this going to be 40 or 50% in the future? Probably not. If it is, then there's something wrong with the capitalist system. I'm not going to bet on that. So let's end here as we always do. Signal or noise, Peter. We got two important things here that a lot of people are talking about. I'm going to start out with King Dollar. And this gets a lot of attention, usually on the negative side. Whenever the dollar is doing strong, people are saying, hold up, oh, this is bad. This is bad for stocks. You want the dollar to be weaker versus its international indices, so things like the euro and the yen. But the dollar has had a great run here. It's up a lot this year. It's up over 40% in the last 10 years. And this is a pretty hysterical one to look at, this table here, given what we just talked about in terms of the national debt and the money supply and inflation. You probably wouldn't have guessed that every single major currency in the world, I spent a lot of time digging up things you probably had never heard of in terms of currencies, but I couldn't find a single one around the world that has appreciated against the dollar over the last 10 years. Every single one, and many by a substantial amount. This is, first of all, before we say whether the dollar's signal or noise, doesn't this kind of shock you, given the narrative that's going on about the end of the dollar and
Well,
the collapse
I
that we're going to
definitely
see?
know that this is noise, but I am stunned. This is the first time I'm seeing this graph. I'm stunned that you didn't find a single one that's out performing. I think that really says a lot about what's going on in the world too. I mean, the U.S. is very, very messy, but it's the cleanest shirt in the dirty laundry, right? I mean, there's just not a better alternative right now, and this is the free market telling us that.
Right. And so in terms of signal or noise, we have a dollar index data going back to, I think, 1973. And you can see it's pretty much where it was back then. And this is against just six major currencies, mostly dominated today by the euro and the yen and a few other European currencies. But if we see that S&P 500 index on the bottom chart there, it should pretty much tell you kind of ignore what the dollar is doing, because S&P index was at like 100 in 1973. We're at over 4,000 today. So this notion that the dollar needs to be weak or strong or what it's doing for the stock market to do well, it's pretty much noise, isn't it?
Yeah, 100%. 100%. I would not making any investment decisions, as this graph points out, around where the dollar's at. If you're traveling, pay attention to it. If you're investing, ignore it.
Right. So I ran the correlation. It's pretty close to zero. And what you'll see is there's periods of time where the dollar is strong and the market's strong. We saw that in the 1980s. This dollar index actually peaked back in 1985. So to give you just an idea here, S&P 500, how much it's gone up, obviously, since 1985, and the dollar's still down versus that level.
Yeah.
But sometimes, as you can see, after 1985, it comes down. The market continues to go up. So you not only need to know, let's say you predict the dollar is going to collapse in the future, or at least, it's been going up the last 10 years. Let's say you think the next 10 years it's going to go down. You have to know, well, what's the reason behind that? Is it because of interest rates? Is it relative flows? Is it because of GDP? All these different factors are very, very complicated. And of course, U.S. corporations have a way of dealing with currencies. They're not looking at it. They're not focused on it day to day. They're focused on profitability and earnings. As long as that goes up over time, you should do okay as an investor. So number two, Peter, and this has died down a little bit, but in September there we had a little bit, like a small moment of euphoria. Nothing compared to 2021, but everyone's saying IPOs are back. We have ARM and Instacart, first IPOs we really had in quite some time that of any size. What do you make of IPOs as a signal? Do you pay attention to IPO activity when you're thinking about the markets?
I don't think there's any question that if the market's very strong and very bullish and it's expected to continue, a bunch of private companies go public because they want to go public into a market where the people that own the private stock can convert it, into cash or into public stock at high levels. So if you see massive volume going into the public markets, then you can expect. Then I do consider it a bit of a signal. Like if I saw that 50 firms were going to go public in the next 30 to 60 days, I would say, wow, that might be a bullish indicator. I wouldn't make my investment decisions based on it, but it would be a cause for optimism. If just a couple are going public, that's not an indicator at all. And that's very normal. There's always companies going public. Sometimes it's completely dry. Sometimes it's off the charts. But usually some activity's happening. It's not an indicator at all.
So my view is that it's a contrarian signal, but only at extremes. So if we look at this chart of IPO issuance in the U.S., you could see what jumps out here pretty clearly. 2021 was by far the biggest year in terms of issuance. We just had an explosion, particularly early, the first few months of that year, and then it just almost shut off completely by the end of that year and into 2022. And before that, what was the biggest IPO issuance? Well, it was 99 and 2000. So when investors get excited, when you start to hear the words hot IPO and things like that, that's when you should be thinking about being a little bit more cautious.
Yeah,
and
you're
definitely more cautious.
You're in a very hot market that will eventually revert to the mean, right?
That's right. There's a reason why supply is coming on there. There's a reason why the investors are going public. That's a good thing for them, right? They're raising money at peak valuations and they're coming to market, and that's a good thing for that company. But for the shareholders, unfortunately, of these IPOs, they didn't do so well. And what I would say historically, and I'm sure you get this question whenever there's a hot IPO, or how should IPOs fit into your portfolio? Because we only hear, or mostly only hear, about the IPOs that have done extremely well. And so, they just show these extreme one-day pops. So I have to get in on that IPO. But to me, that the hotter the IPO, or the more that it's popped on that first day, the more you should be going the opposite direction. That means that all of that future returns is being pulled forward. We saw this with so many examples in 2021. In 2020. And this is just an interesting thing here, that the NASDAQ 100 since this IPO ETF came out in October 2014, NASDAQ 100's up 389%. The IPO ETF is up 59%. So you weren't missing. And during this period of time, you had probably arguably the best period other than the 90s for tech in history. You weren't missing out, right, on having that IPO exposure in your portfolio, right?
Yeah, I mean, the average IPO is trading lower 6 months later. I think people they think they're getting something that nobody else is getting. Let the insiders do their thing and wait it out. If you're going to buy, wait till the future, and on average, you're going to do better.
By the time it gets into the index, it's established, it has earnings, it has revenues, you're still going to participate if there's a lot of
That's
upside. Right. And if it's so hot, like, even Instacart, if you looked at where it went public versus, the most recent rounds in the private market, just 80% lower. So it shows you that when you have this extreme sentiment, you have this euphoria, the timing really does matter, and it's very difficult to assess that with these IPOs because many of them don't have income. They're just based on revenue. It's hard for investors to differentiate. But final point on that, this is why you don't chase. In early 2021, this is when everyone's telling you have to get involved in these IPOs. And the performance of this IPO ETF and the flows were enormous. Speaking of that behavior gap, the flows into this IPO ETF were enormous in that first 2 months of 2021. Now we have the result of that negative 55% returns for that IPO ETF. The NASDAQ 100 is actually up since the beginning of 2021, since February 2021, up 13%. So valuation does matter. When there's a mania going on in the market, if anything, you want to use that as a contrarian signal. So Peter, we covered a lot of ground today. I want to end it right there. Thanks everyone for joining us on Signal or Noise. If you're watching this on YouTube, you can follow us on all of the podcast platforms that you like to listen to, Spotify, Apple. So check us out there as well. And we'll see you next time on Signal or Noise. Thanks.